3, 2, 1.
New York, NY. LaunchPod starts now.
Welcome to a special episode of the New York LaunchPod. I am very excited to announce a brand new series that you will see from time to time in addition to our monthly podcast. We've had on some fantastic guests, and a lot of people have reached out to me and said, what happens to your guests after they appear on your podcast? Well, if you go on to nylaunchpod.com and subscribe to our freshly rebranded newsletter, you will be able to track their publicity each month. But we also wanted to do some follow-up interviews. Our guest to kick off this series is Angela Ceresnie, who first appeared on episode 8 as a co-founder of Orchard. She has moved on to a new startup called Climb Credit. We checked in with Angela, and I hope you're as excited as I am for this production that is about to hit your ears in our very New York series called How You Doing?
Hey, how you doing?
How you doing?
I'm doing good.
How you doing?
I'm doing good.
I'm doing good.
What'd you say?
I'm good.
Hey, you? I'm walking in.
Fantastic. What you say? How you doing?
So you are back. Welcome back, Angela Ceresnie.
Thank you for having me.
So how does it feel to be back?
It feels like I never left.
It feels like you never left.
Yeah.
So you've taken on a new position. We know you from episode 8 with Orchard, and now you've moved on to a new startup called Climb Credit, and it felt like the perfect opportunity to have you back for How You Doing?
I'm so excited to be your first installment of that.
So what is Climb Credit?
If you'll recall from the episode where David and I were here talking about Orchard, one of the things that we discussed was a new lending ecosystem, and Climb Credit is a part of that new lending ecosystem.
And for listeners who are tuning in and who don't know what the new lending ecosystem is about, first of all, you should listen to that episode. But if they haven't, what is a new lending ecosystem?
So historically, if you wanted to get a loan, whether it was a student loan, a home loan, credit card, there were a small number of very large players who lent. So companies like Citibank, Chase, American Express. In the last 5 to 10 years, there have been a number of smaller startup companies who have created better and more user-friendly, or in some ways more niche lending products for specific audiences. Some large companies that people probably have heard of are Lending Club, Prosper, SoFi, who have approached the lending market from various angles. Climb Credit is approaching the student loan lending market from a different angle than has historically been approached.
What is this new angle?
Yeah. So what we do is we try to align all the interests. So typically today, if you have a student loan, or any of your listeners have a student loan, you probably got it from the federal government and maybe got some additional private student loans from either Sallie Mae or your bank or maybe some other companies. Those lenders typically advance the entire tuition up front to the school. And so what that means is that a school is then incentivized to, instead of making sure that you get a job and can pay back that loan, instead to fill the next seat the next year so they can get that tuition. We've created a lending product that advances a portion of the tuition up front to the school, which means that the school, and then the school receives the holdback over time as the students pay back, which means that the school is now incentivized to provide the best education and the best career support to the students so that they'll make the money to be able to pay back the loan. And our product also is available to anybody who attends the program, regardless of credit. So if you have a great FICO score, wonderful. If you don't, if you either have maybe weak credit or no credit at all, we have a product for you. And we're able to manage that risk because we advanced only some of the tuition to the school.
And so why are schools signing up if they're not getting the full amount of the loan? It seems like an interesting thing that no one's ever done before.
Yeah, no, that makes sense. So the reason it makes sense to the schools is because we can offer a product, a lending product or a loan to any student who wants to attend. And so another layer of our business model is that we only work with schools that are what we call ROI positive. So a school has to be providing an education that makes sense financially when compared to the cost and the amount of time you have to take out of the workforce in order to attend. So if you are making minimum wage, which we assume is about $20,000 a year, and you go to a nursing program, let's say, that's 8 months long, costs $10,000, and coming out, you make $30,000, that's a great investment. But if coming out, you still only make $20,000, that's not a good investment because you took that time out of the workforce and you now owe $20,000 or $10,000, whatever the tuition was. So we run a really thorough analysis on every single program that we work with to make sure it hits those standards of being a positive ROI to the students. And then once we've felt comfortable with that, as I mentioned before, we'll underwrite everybody. Everybody. So from a school perspective, they like the fact that they can have a one-stop shop. If you're an admissions officer at a school, the last thing you want to do is have to offer 3, 4, 5 different loan applications to your potential students, because then they're having to hear, no, I'm declined here, I'm declined there. Oh, I can only get a little bit here, that sort of thing. And so what we're able to do is we're able to say, send everyone. We're already comfortable with that your education that you provide is of a positive value to the students. We've assessed your graduation rates and your job placement rates, the industry that you're putting people into, and we feel comfortable with that. And because on the lower credit people, we might advance a little bit less, the risk to our investor base is a little bit lower. So it aligns all of the interests.
And so what schools are you working with? Because I was actually on the subway the other day and I saw a subway ad and it was, I forget what the school was, but it says, we catapult more students to the middle class than the Ivy League combined. And I thought that was sad for the Ivy League. I may not be quoting the ad exactly, but generally there are schools that help students increase their incomes and increase their, let's call it, social standing. What are the schools that you're working with?
So we work with a really broad range of schools. We started with the coding boot camps. The reason we started with those, for your listener base who might not know, coding boot camps are programs that have been popping up, I would say, in the last 5 to 10 years that take typically people with a college degree, but not always, and train them to be entry-level software developers. The coding boot camps, some of them are small mom and pop type schools that train, somewhere around 50 people a year. There's really large ones like General Assembly, who's a partner of ours, that trains thousands of people a year. That was where we started. Our founders, who are our CEO, Xander Raphael, our CFO, Amit Sinha, and our chairman, Vishal Garg, saw the coding boot camps as the best entry point to being able to fund this type of education because they're very high ROI. They take people who are making, $40,000, maybe $50,000 a year and immediately get them after sometimes even a 12-week program, a job making $60,000 a year as a software developer, which is, a great track to be on. There's no financing options. So they don't have access to federal funds. Most of the large private student lenders don't work with them because they're still relatively small. And so it was an easy, I think, entry point. Now we work with all types of schools. So we work with healthcare schools. We work with truck driving schools. We work with schools that teach people how to use heavy equipment and other types of machinery. We work with schools that augment education. So somebody who is a K through 12 teacher and needs to get a master's degree in order to either keep their job or make more money. There's several online programs that offer that. We work with some of those. So.
And how long are the schools? They're not colleges, right?
They can be colleges or universities. The programs themselves tend to be about 2 years or less.
What makes these schools increase people's incomes? What are the factors that you're looking for in these schools that say, this is a school that will help someone and versus a school that will not help someone? Because that's certainly when you're in the private sector, it's obviously been a big issue recently about private schools. Some schools are not helping people's income. Some people are. You're in the credit world evaluating these schools, and you're looking at all these schools closely as opposed to a student. What is increasing people's incomes?
The most important factor at the beginning is the industry. So if someone came to us and said, we're a school that teaches people how to fix fax machines, you'd say, well, that doesn't really seem like a growing sector, right? So first, what we do before we work with any type of school is we have an understanding of the vertical in which they're teaching people to be able to get jobs.
And what are some of the hot verticals?
The ones I named are
trucking.
Yeah, trucking. We see more positive results from local trucking as opposed to the long segment trucking. So that is a growing field. Again, before we work with any school or any industry, we do research. And so we've talked to a lot of people in that industry and others and have an understanding of, what the kind of bull and bear cases are for the industries. Healthcare is obviously a growing field. We see an IT training. So not the coding boot camps, but the IT training, teaching people how to be Cisco certified, and there's some Microsoft certifications where there's still a pretty big demand. What's also interesting about the coding boot camps is, I think, especially from living in New York, you probably think of, okay, so someone goes to the coding boot and they go work at a startup, right? Or they go work at Google or something like that. One thing I've learned since joining Climb and meeting with a lot of these schools, particularly outside of the coasts, is that a coding boot camp in Louisville, Kentucky, is training people to be software developers at the insurance company there. Or a coding boot camp in Las Vegas, Nevada, is teaching people to be computer programmers at the gaming companies that make the slot machines. Those boot camps are actually teaching different computer programs than the one in San Francisco or New York or Austin. So even there's kind of a broad range. But the most important factors are graduation and placement rates.
And how do you find those out? Because I know that was a big thing. I'm a lawyer. It was a big thing for law school about graduation and placement rates, that you can kind of fiddle with the numbers a little bit.
You absolutely can. And actually, it's funny because I have a lot of friends who are lawyers or went to law school. And I remember hearing the kind of complaining about how you don't really know the placement rates and all that of the schools, because a law school will count someone who's working as a waitress, as a employed graduate, when fact you don't.
They were counting employed by the school a
right.
little bit.
So we absolutely see that same stuff. So I actually had a school that we work with submit some diligence information. We do recurring, where every year they have to continue to send us information. I had a school send us something a couple weeks ago where I saw that a number of their graduates were working at the school. So, that's a follow-up.
You'd followed up? You didn't drop them?
No, it wasn't enough. It wasn't enough to drop them, but it was enough to follow up and ask some questions.
Placement rates and industry are your two main ones.
Yeah, and it's graduation rates. Because actually what's interesting, so Title IV, which is the federal funds that are dispersed through the federal government to schools that accept that, they publish all their data. So for every school what their performance is on repayment on their Title IV loans, and a bunch of other data about how their school performs. And we have a plot that a graph that plots the placement rates and the default rates, the graduation rates and the default rates. And what you see is, as the graduation rates go up, the default rates on the federal loans go down. So you have schools that have 20% graduation rates. And most of those schools have really high default rates on their loans, because you have people who have now taken out a loan and they didn't even get the goods. Because you don't graduate, you don't really get credit.
And that's what you're talking about with the incentive, because their incentive is to fill the seat, not to graduate the student.
That's right. They already got 100. And, most schools aren't nefarious, right? But you have incentives, right? And where are you going to put your resources? And, one of the challenges that has been identified in some of the schools that have been really called out as being not doing the right thing. So some of those, there've been a lot in the news, ITT, some of these other companies. One of the things that they all have in common is their largest line item is marketing, because they're out there marketing to fill the seats. They could take some of that money and put it towards career counseling and, job placement assistance and stuff like that. And you see schools who put resources towards that sort of stuff having better placement rates.
So when Climb Credit is with a school, are you partners? Are you the exclusive lender? How does the relationship work?
So it depends on the school, but we consider them partners. And in fact, we have a team that's dedicated to managing the relationships with our school partners. We treat them like clients. So they're very important to us, mainly because their business is our business, right? Like our entire business development team is out there talking to schools. But part of the process of getting a school on is doing a lot of diligence on their performance.
How much diligence?
It's a lot. It's a lot.
I mean, what are you talking about? Because I ask this because a student is looking at a school and they are applying to different schools and have a job or maybe not the resources that a credit team has in terms of what you're doing. But how much time are you actually spending on diligencing one of these schools?
So sometimes it'll be, our 6 weeks.
6 weeks. How many people?
Well, I mean, it's back and forth,
Yeah.
but yeah, I mean, this is how it goes. We call up a school, or the school calls us, and we send them basically a data request. We ask for program level data for every program that they want us to help finance. And we have a whole calculation, an ROI calculation that we've developed and fully documented that we run every program through. If the data doesn't check out for some reason, it either looks high compared to other ones we've seen, or for instance, if let's say it's a nursing program and they say that their graduates make $150,000 a year starting on average, but we know based on BLS, the Bureau of Labor Statistics, and other publicly available data sources that same type of nurse actually makes $90,000 a year, then we probe. We either just notch it down to 90 or we ask for more details. So we do quite a bit of back and forth there. If we find that the ROI for a program at a school is greater than 7.5%, then we're generally comfortable with the quality. At the same time, we're also doing a thorough review on the corporate entity itself, making sure there's no lawsuits, background checks on all the executives. We review all their financial statements. You want to make sure that the company's going to be around. After all of that is when, as an organization, we make a decision whether or not we want to work with them.
And do you become the exclusive lender for that school?
It depends, not always. With Title IV, where there's federal loans, they're not allowed to have exclusivity with private student lenders. If there's no Title IV, then they don't have that requirement, so it's allowed. We are exclusive with a few schools, but we do find that schools having an exclusive relationship is a little bit risky on their part, because if that lender were to go away for some reason, then they don't have any... they don't have a lending option for their students.
Right, that makes sense. And what's the interest rate for the loans?
So it's as low as 5%, and it can go as high as 12%.
And that depends on the student's credit score or the school?
Both. So some schools elect to have a flat credit score, so everybody there has the same interest rate regardless. If a school doesn't choose to do that, then it's based on FICO, on risk.
And how does that compare to federal student loan interest rates?
It depends. For the most part, it's higher, partially because just cost of capital. So the federal government has the lowest cost of capital out there.
You don't have the ability to print money?
Yeah, right, exactly. Getting there, working on it. So I'd say it's higher, but it's comparable to any other options that are out there to augment the federal government. There are some federal government programs that are higher than that. So some of the parental loans and more fringe lending products that they offer.
So why does a student go with a Climb Credit loan versus a federal?
They would not. So another thing to understand about our business is we understand that if you can get money from the government at a 3% interest rate, or you can get a scholarship or a grant funding from the GI Bill, you'll absolutely take that. And we would never recommend that a student not take that. We fill the gap. So at schools that accept federal financing, those schools are not allowed to fill their whole tuition with revenue from the government. They have to have either cash or private student loans to cover some portion. So that's where we're at. And based on our estimates, there's about a $190 billion market out there.
For private loans.
Yes.
And what's the default rate in your loans?
So the default rate depends on the school, but it tends to be in the single digits.
How much capital do you have to loan out?
A lot.
A lot.
A lot.
I thought you were a little startup. No,
We are, but we have basically, two sides of our business, right? So we work with the schools. That's where we get our partners and our end customer, the ultimate customer, which is the borrower, the students. We also have a whole investor side of our business, which is raising the capital so that we can lend it out. That we've been very successful at. We've got a number of really great partners and hundreds of millions to lend out.
Really?
Yeah.
So you're ready to give out the money?
Yes.
Do you sell the loans?
Yes, that's part of the way we finance the business is we make the loans and we sell the loans. So we have sort of different options in terms of how we fund them, but we do, which is interesting because that was sort of the crux of Orchard's business, was facilitating the sale of whole loans.
Which is where you came from.
That's where I came from.
And so you're familiar with this marketplace.
So I'm familiar with the model, yes.
And what's your role now in Climb Credit?
I'm the COO.
And what does that mean?
Just like any COO, it's a little bit nebulous, but I run the day-to-day operations of the company, which can be anything from just the office to, our strategic planning and thinking about, where should we be 12 months, 24 months from now. On a day-to-day basis, I run all the legal and compliance, which is actually a decent amount because we have to have a lending license in every single state.
How many states are you in now?
44.
That's close to 50.
So close.
So close.
So close. We got a few holdouts. Got to get the Dakotas.
Dakotas, New York, you have?
New York has in a lot of states, there's usury laws, right, where if you lend below a certain APR, you don't need a license. So we, in some states, rely on that. And in other states, you have to have a license, or every state is different.
But you're lending in New York.
We are lending in New York.
Excellent.
And California.
Yes. And how many people are with your company that is lending out billions of dollars?
We're at 20 people.
You came from Orchard. You're familiar with this new ecosystem. Are there other people that are doing similar things to Climb Credit? How is this new ecosystem working?
Yeah, so there's a few players that are in the student loan space. So two large companies that people probably would have heard of are SoFi, who is pretty big. They had a Super Bowl ad.
Heard of them.
Yeah. And Common Bond, who's similar to SoFi. They're New York based. They are more on the refi side of things. So what they do is you go out there, you get a federal loan to go to law school. It's at 6% interest rate. Everybody gets 6% interest rate, regardless of your credit score, whether or not you graduate, because they obviously don't know that when they give it to you, whether or not you pass the bar. So once someone has graduated and passed the bar, the risk on that loan is going to be far lower than whatever it was priced at when it was initially issued. And so those companies refinance student loans on people who have graduated. So it's a little bit of an interest rate arbitrage. Great business, both of them. And they both are starting to do other things too. But what we're doing, which is lending to students as they're entering school instead of refinancing later, is a bit more unique within the kind of like startup ecosystem. Not really a lot of other players doing it. And part of the reason why is it's hard. It's really hard.
What's in it for the school if they're only getting part of the money up front?
To be clear, most schools get 70%, or 80%. It's not a tiny amount. It's high enough. But again, I think I mentioned this before. It's the single point of sale. So one of the challenges that we've learned as we've worked with more and more schools is that an admissions director, admissions officer who's meeting with students and trying to tell them about the program, explain to them what the financing options are, would prefer to have just one place where they know the person can apply and just know that they'll be able to get a loan. So you know the federal government's there for some amount. There's going to be some left over. If that leftover, you know they can get financing from Climb, that's a really, really great incentive for them to work with us.
What makes Climb unique? Why is Climb going to win?
I think there's a number of reasons why. One is we have a great team, a really, really good team of people who are dedicated to the mission, working really, really hard to further the objective of expanding access to quality education. The second is, I think, because we are mission-based. So we don't work with schools that we don't think are doing the right thing, or even programs within a school that we don't think are right. And that can be really hard to do, because when you're a startup company trying to grow, it could be easy to say, well, that program's not the best, but it's there. It would get us more volume.
And it has a good name.
And it's got a name, or they want to work with us or whatever. And I think we've been really disciplined about not doing that. And I think that's going to pay off in the long run, both from a brand and sort of just doing the right thing perspective, but also I think from performance. I think we will see lower default rates, higher student satisfaction, fewer CFPB complaints, like all of the positive things as a lender that you would want, because we're only working with schools that are doing the right thing.
Well, that's great to hear that schools are doing the right thing. We know you from Orchard, which we talked about. How come you left Orchard to go to Climb Credit?
I was excited by Climb's mission. Climb is just onto something really special. I think we're riding a future wave of something that needed to happen in education, which is moving away from the one-size-fits-all. Everybody goes to the four-year university and gets, either pays for it themselves if they're lucky or gets a ton of loans, and then you figure it out. I don't think that's where we're going as a society, and Climb is positioned really well to help enable our education system to move in the right direction and to capitalize on it at the same time.
Well, it's very interesting that you talk about the socioeconomic structure, because it's certainly a hot topic in the education world, and we see tuition increase, and four-year colleges, which people thought you have to go to college, you're saying may not be the future, and may not be the future for everyone.
That's the thing, is that I think that I recall when I was graduating from high school that there were like two tracks. There was like you went to college or you didn't. And there wasn't this option of, you go work for a little while and then maybe you go to trade school, or maybe you go to vocational school, or maybe you go to a coding boot camp, or maybe you go to nursing school. And it's not 4 years. It's just a year or two, right? And it's instead of $80,000, $100,000, $200,000, it's 20. Those options weren't clear. I just don't think they were clearly available to people or presented. Part of what we want to do is present those. And for some people, they'll make sense, and for other people, they won't. But I certainly wouldn't want what's happening today, like without Climb. Someone does find one of these great schools. They go there, and because they have not a great FICO score, no credit at all, they can't get that additional loan to cover the gap that the federal government can't fund, and so they can't go. And so then they can't get that education, which means that they can't have the wage growth and the life trajectory that it would put them on. And I like that we're enabling people to do that, and I hear about it all the time from our, we have student outreach and success stories that we put on our blog and stuff like that, and it's, it's exciting to hear about somebody who is enabled to go to one of these programs by a loan we gave them.
Well, it's a great company that's doing a fantastic thing. In addition to making a profit, it seems like you're really helping people, which is also wonderful. Angela Ceresnie, thank you for stepping back onto the New York Launch Pod and sharing your time with us.
Thank you, Hal. It was a lot of fun.
And if you want to learn more about the New York Launch Pod, you can visit nylaunchpod.com, including transcripts of all our episodes, including this one. And you can follow us on social media at nylaunchpod. And please, if you enjoyed this episode, leave a review on iTunes. It does help people discover the show.
Thank you for listening to this episode of the New York Launch Pod. For more information, please visit nylaunchpod.com.